The housing crash is starting to look a lot closer like 2008 than the 1980s.
Who are watching us from the last home you'll ever own tonight, consider yourself lucky. Same goes.
2 words on the American front lawn. Do they now have the ring of a prayer, a plea to the market gods? Get me out of here.
As more data comes in showing a struggling housing sector, the National Association of Realtors of Home Builders CEO, Jerry Howard joined the show earlier today to tell us what they see happening.
Having an impact where we firmly believe that we're in a housing recession right now.
Housing starts off 16% from a year ago. Permits are down 22% from 2021 in November. Just in terms of what this is signaling of how much worse the industry could potentially get over the next 12 months. What do you think?
Because of the lack of buyers, the builders are becoming very cautious.
Banks currently have borrowed $152 billion from the Fed, and the last time this happened was in 2008, where banks borrowed $111 billion. So far, we've had 3 banks collapse, and the last time we had a bank collapse bigger than the 2 banks that have collapsed was in Lehman Brothers back in 2008. Amazon has started to lay off their 9,000 employees after they already laid off 18,000 employees in 2022. Indeed, which is the platform for hiring, has now laid off 2,200 employees, and Disney started their 7,000 employee layoffs. You see, what does this mean for our local market? When we're talking about the local Boise market, just recently, I had a conversation where an HVAC company just went out of business. They had around a $4 million revenue a year, and now they're belly up. On top of that, just recently, I just talked to somebody who moved here a year ago because of a job. They ended up getting laid off, and what they owe on their house is more than what the house is currently worth in this market. On top of that, they can't even rent it out because what their debt service is or what their mortgage payment is way more than what they could currently rent it for. So now they're stuck in a bind. And this is why I want to share these things with you. I lived here through the 2008 bust. I watched the boom and I saw the bust, and I am passionate about letting my subscribers and my clients know we saw this happen before. People were saying this isn't going to happen. It's not going to happen. And then it happened. And all of a sudden, all these people that bought houses back in 2007, 2008 that weren't following the trends in the US economy, all of a sudden got stuck, and they had to stay in that house for 10 years, or they had to short sell or foreclose on a house. And that is why I'm passionate, and I want you guys to be aware of what's going on. You see, back in 2008, 26 banks that went bankrupt. In 2009, that jumped to 140 banks. And in 2010, there was 157 banks that went belly up.
Another one. Another one. Another one. Another one. Another one. And another one.
Look at all this damage!
Now that's a lot of damage!
This is cancer. This is so much cancer that I can feel the tumors growing on my back. And it's weighing down heavy on me, and it's not okay.
Oh, how are you? I am under the water. Please help me. Here too much raining.
Does any of this sound similar? We have to be open to the time. Federal Reserve is saying this Silicon Valley Bank collapse was it's just a one-off thing. It's a one-off thing. When they started doing this quantitative tightening, they dropped their balance sheet by about $500 billion. In a matter of a week, they injected another $300 billion. So what does that really tell you? Not what are you hearing them say, but what are the actions that they're doing that's really telling you how they feel about the current housing market? Yes, we did see a 25 basis point increase, but does that really mean they're going to stay the course, or were they just doing that to save face? And the same guy who's saying that this Silicon Valley Bank, Signature Bank collapse is a one-off thing is the same guy that came out and said that inflation was going to be transitory. And we all know that inflation isn't transitory.
In the end, it will be transitory. And people need to have faith in the central bank that we will do that. But
we're all feeling it. Now, he hopes that the banks are going to tighten lending standards, which Again, if they tighten lender standards, then that's going to hurt the everyday consumer who right now is living paycheck to paycheck or has to use their credit cards just to get by. But what can cause these bank failures? Not enough liquidation and too much assets underwater. For instance, according to this article from Globalist, they have 5 markets where the office loans are maturing in 2025. Atlanta has about 29% of their office space that are going to mature, followed by Portland at 27%, Denver at 24%, Chicago at 23%, LA at 21%, Washington, D.C., Austin, Dallas, Fort Worth, all at 20%. What's also interesting is that some of these vacancy rates are sitting above the national average. For instance, Atlanta is sitting at 20.5%, Chicago's at 19.2%, Denver's at 17%. So with these vacancies rising in the office space, these owners are going to have to go and refinance. But if the vacancies stay high, then the values will decline and make it harder for the banks to refinance. And that's where the lag effect we have been talking about will hit. We're going to see this full ripple effect probably in a couple years. Because look at this article from Wall Street Journal. 72.5% of employees are saying that they rarely have teleworkers or they have 0 teleworkers and they're all coming into the office. This is a climb from 2021 where it was only sitting at 60%. So although people are being called back to work, which was higher than in 2020, 2021, the office vacancies are climbing. This means that vacancies are beyond just people working remotely. And if companies are calling their workers back to the office, what's going to do to those who have moved out of the market and bought a house where they were planning on staying and working remotely forever?